If you are 55 years old and you have $250,000 saved for your retirement, congratulations. It is no small feat to build this level of savings by the time you turn 55. And just so you are aware, if you are 55 with $250,000 saved for retirement, you're ahead of about 85% of the American population. Now, if you do have this level of wealth and you still feel a little uneasy when it comes to your retirement readiness, I want you to understand that your path to a comfortable retirement is much easier than it seems. In this video, I'm going to get into the specifics of building a retirement plan for someone like you. And as we build that plan, what you're going to realize is you may not have to work until 67 for you to finally hand in your notice. Stay tuned. Welcome back to Financial Wellness Planning. My name is Derek Coffey, and I'm the founder of FWP. And if you have made it to 55 and you have saved that $250,000 for your retirement, then the opportunities that are available to you begin to open up. Because you understood the importance of investing and doing it diligently over the course of your career, there are going to be opportunities that you can take advantage of that someone with no savings cannot mathematically achieve. Before we can really begin building the retirement plan for our sample couple, we need to lay some groundwork. We need to understand what their current situation is. If you've watched any of the other videos in this series, you've seen this sample couple before. They are married. They bring in $130,000 a year before taxes. Their monthly needs-based spending is $5,000 a month. Now, that amount could be higher or lower depending on where you live, but where I live, this is sufficient. The difference between this sample couple and the ones we've seen in the past is that they have the $250,000 saved for their retirement. We're also going to assume that they're eligible for a 5% dollar-for-dollar match on any contribution they make to their 401ks. Because they have the $250,000 saved up, it's reasonable to expect that they're contributing the 5% to get that full company match. Now, when it comes to projecting what their retirement is going to look like, the first thing we need to know is what their Social Security benefit is going to be. For our sample couple, we're going to assume that they're each eligible for $2,000 a month in Social Security benefits at their full retirement age. Because they're 55, their full retirement age is going to be 67. When it comes to their needs-based spending in retirement, we're going to assume that it's going to cost them $4,000 a month. In other videos, I go into why I choose $4,000 a month, but I'm not going to bore you with that in this video. But what you see on your screen are a list of the expenses that I would want my clients to plan for. Now, keep in mind, there is some wiggle room. There's some cushion that's baked into some of these expenses. But at the end of the day, this list of expenses is $3,050 per month. If we assume that our sample couple is going to have a 10% effective tax rate in retirement, then they need to bring in $3,388 to pay all of their bills. What we're not factoring in is any fund money. There's no money really left for them to enjoy their retirement. So if we round the $3,388 up to $4,000 flat, this is going to give them some spending money to go do the things that they want to do. Now, the one thing that we're not factoring in, at least to this point, are healthcare expenses. And when we get to the planning software, we're actually going to budget in $500 a month per person. And $500 a month is quite reasonable. When you factor in all of the costs associated with your healthcare and retirement, $500 a month per person, at least in today's dollars, is going to get you on the right path. Now, that $500 a month is going to include things like your Medicare Part B premium, which as of 2024 is $174 a month. It's also going to include any prescription drugs or any vision services or dental services that you may need. But when it comes to planning for our sample couple's retirement, we're going to add in another $1,000 a month on top of the $4,000 a month they need for their needs. So our sample couple's all-inclusive retirement cost is going to be somewhere around $5,000 a month. So now that we understand our sample couple's current situation, we can begin building their retirement plan. Now, what you see on your screen is our sample couple retiring at age 62. Now, I know they only have a 17% chance of this plan actually succeeding, but it is much better than the other videos that we've done for 55-year-olds that either have nothing saved or have $100,000 saved. For them, retiring at 62 was completely out the window. It wasn't even an option. But because our sample couple was diligent with their savings and committed to building towards their financial future, they at least have given themselves a 17% chance of retiring at age 62. Now, 17% isn't as near as high as we would like it to be. I personally like to see this number over 90%. So there is some work that needs to be done, but I do want to highlight the fact that if you are 55 with $250,000 saved, you could theoretically retire at age 62. Now, to get their probability of success over that 90% threshold, we're going to increase their retirement age. Now, keep in mind, we're only increasing their retirement age by 3 years. We're not increasing the amount that they're putting away. We're only increasing their working career. By increasing their retirement age to 65, their probability of success goes up to 76%. And this is much better than the 17% had they retired at age 62. Now, 76% is fine, but it's not good enough. There are still some changes that need to be made. And I'm going to take you through 2 separate options that I would suggest this couple to use. The first one's going to be the boring one. We're going to increase their retirement age to 67. If we increase their retirement age to 67, the probability of their retirement plan working goes up to 97%. And again, we've done nothing to their savings rate. They're still only saving the 5% that they've been saving. What I want to show you is what their cash flow looked like. So because they're 55 years old, we haven't increased their savings rate. We've only extended their working career to 67. Nothing changes. They still have $130,000 coming in. They have $5,000 a month of expenses. They're paying $27,000 in taxes. They're setting aside the $6,500 into their 401ks, and that's going to leave them with $36,886 per year to do stuff with. This is $3,000 a month that they can use on whatever it is they want to use it on. And I've said it before, but I want to say it again. When you're planning for retirement, especially in those later years of your working career, you're walking a tightrope with your money. You want to be able to enjoy the money that you're making now, because in most cases, you're in the highest earning years of your career. But you don't want to overindulge because you don't want to throw off any retirement plan that you've built. With our sample couple, they can have the best of both worlds. They get to enjoy $3,000 a month until the time they retire, and they can take whatever trip they want to take. They can pay for whatever they want to pay for. They can do anything that they want to do with that $3,000. But because we've extended their working career, them retiring at 67 is still going to be very comfortable. They're going to get $59,173 from Social Security. They're going to take $40,200 out of their 401ks, and their total income for the year is going to be over $99,000. We take out all of the expenses that we've already accounted for with a little bit of cushion, the taxes that they're going to owe, which is going to be right around 4.5%, which is really good. And then that's going to leave them with almost $700 a month that they can use in retirement for whatever they want to use it on. Now, the one thing I do want to address about their cash flow now is of that $3,000 a month that they would be bringing in, I would urge them to build a retirement emergency fund. And if you haven't watched any of the other videos in this series, the purpose of that fund is to pay for the big ticket items you may experience in retirement. And these big ticket items are things like a new roof, a new HVAC system, a new vehicle, if the vehicles you have are aging. But the purpose of that fund is to keep you from pulling additional money out of your retirement accounts. So if our couple took $425 a month and saved that in the bank, and this is going to equate to $5,100 a year. By the time they retire, they're going to have $60,000 in cash just sitting at the bank, and that's there to cover those big ticket items. But the probability of success when it comes to their plan increases to 98%. If we go back to the cash flow page, the $3,000 that they had gets reduced by the $425. So they have $2,575 to go and enjoy life from now until the time they retire. So that's option number one. That's the boring one. That's not as exciting as maybe retiring a little bit earlier. Maybe they don't want to work until age 67. If the numbers work out and they're able to save a little more, then maybe 65 is their target retirement age. Well, that's what we're going to get into. So, as we've gone over before, if our sample couple decides that they want to retire at 65 and not increase the amount of money that they save, they have a 76% chance of their plan succeeding. Again, we want to see it above 90%, so we do need to increase their savings just a little bit. So, if they do want to retire at 65, we can increase their retirement savings to 10% each. Still assuming that 5% match, the probability of their plan succeeding increases to 86%. It's still not at the 90% level, so we are going to save a little bit more. But the whole purpose of this is that if they do decide to retire at 65, I want them to feel comfortable with their decision. So to get their probability over 90%, we're going to go to 15% on their savings. Yes, this is a tripling of what they're currently saving, but that's what it's going to take if they want to retire before age 67. So by increasing their savings to 15%, the chances of their plan succeeding increases to 92%. This is where we want to be. Now we're still going to go look at their cash flow situation. So in the present, they're still making the $130,000. We've gone through all of this, but they have $26,194 left over each year to enjoy. It's not as much as the $3,000 a month if they were to wait to retire at 67, but because they want to retire a little earlier, this is one of the sacrifices they have to make. But they're still going to have over $2,000 a month to go do the things they want to do. Now, we're not going to skip on their retirement emergency fund. We're still going to factor that in. So we add the $5,100 or the $425 a month that's going into the bank. It increases their chances of success to 94%. And still leaves them with about $1,700 a month to do the things they want to do. Now, their first year of retirement is going to look a little bit different than retiring at age 67. Retiring at age 67 left them with just over $8,000 a year of money that they could use on whatever they wanted to use it on. If they do decide to retire at 65, they're still going to bring in $91,000 their first year of retirement. We take out all the expenses, the tax payments, and that's going to leave them with $4,482 for the year to go do whatever it is they want to do. Now, that is a reduction from them waiting until age 67 to retire. It's almost a 50% reduction. And this is another sacrifice that they have to make to retire at 65 versus 67. But the entire purpose of this video is to show you that if you're diligent with your savings, then these types of opportunities can open up for you. Being 55 with $250,000 saved gives you the opportunity to mathematically retire with a very high probability of not running out of money at age 65. If you compare this sample couple to the others that we've gone over so far, their retirement options look completely different. The other two videos we've done up until this point, they had to work until 67 to make their retirement plan possible. Having that $250,000 saved opened up different opportunities. They could still plan to retire at age 67 and not have to worry about changing anything about their life. But they could also save more and retire younger than 67. Just by increasing their savings rate to 15% apiece, they could reduce their working career by 2 years and it not really affect their retirement plan. This is the importance of saving for your financial future. The sooner you start saving for your retirement, the easier it's going to be for you to get to retirement. And it's also going to put you in a position to potentially retire sooner. I want to thank you so much for tuning in. If this video or any of the other videos that I put out has provided you value, then hit that subscribe button. If you know someone that has a little bit of money saved and they're still uneasy about their retirement readiness, then send this video to them. Maybe it'll help them feel a little bit more confident with their decision. But I thank you so much for tuning in. I'll talk to you soon.